We've got two speakers fairly directly involved in the land issue from the point of view of valuation and markets. The first of those is Tim Lane. Tim joined ANZ in 1987 and had held roles as a commercial banking manager. Sorry, I've jumped the gun. I should have said you have to go back to your seats too. But I'll keep things going. So Tim holds a Bachelor of Business with major in Economics and Operations Management and is commencing the Australian Institute of Company Directors course. He's the Director of Rural for Herrington White, and his knowledge in the banking environment, which is supported by having family and personal interest in agriculture, provides a strong capacity to assist the national growth of the rural focus of Herrington White. Tim is also a Director of Herrington White Environmental, which is involved in providing biodiversity offset solutions to the marketplace. So to discuss a number of these issues from the perspective of the market for land, please welcome Tim Lane, who I've also discovered is distantly related, which is something you learn every day. Thank you.
It's a long line of relationship for the connection, so we don't look alike, obviously. Ladies and gentlemen, thank you very much for allowing me to present. And the topic of this presentation is how urban mining and direct foreign investment affect rural valuations in Australia. So a fairly large topic in its own right, and just allow me to grab my notes out. The issue of agricultural land values and all the things that are happening with that topic alone, and I suppose based on the conversations from the previous session, one would think that prices would be raging out of control. The whole country's been sold up to either mining or foreign companies, not so much necessarily on the urbanisation relative to the growth of cities and that at the moment. But that's indeed not the trend at all in terms of broad-based agriculture. So the first chart here represents basically an index which has been in existence from the Herrington White Group since 1980, and fundamentally represents the long-term trend Australia-wide for pastoral holdings, and each state slightly different at the starting base. So Victoria, greater than 150 hectares, New South Wales, 250, Queensland, 500 hectares upwards. But fundamentally represents the trend in terms of where agricultural values are going. Now that chart is up to 2010, and only this afternoon I've just got the updated 2011. And certainly if a little pointer works, the trend line has continued just to deteriorate back to the point where we're sitting somewhere between 05 and 06 numbers relative to broad value in terms of agriculture Australia-wide. So this doesn't dissect by commodity class, it's really just saying the broad, what's sold in the market. It has also stripped out mining and gas sales because that shows an inflated number. So across the board, agricultural land values are declining and certainly have come off the highs in terms of the market over the last few years. Break that down a little bit further by the zones themselves. So we broadly categorise into the pastoral zone, the wheat, sheep, the high rainfall. And as you can see, the broad index there, the high rainfall, significantly took off, fuelled largely by the foreign investment and the managed investment scheme funds into largely the timber plantations. The broad general markets for the wheat, sheep and pastoral are a lot more steady in terms of growth, but significant growth from that period, roughly 2004 through to 2008-09. In Queensland, the Queensland Rural Adjustment Authority do a survey of all the banks every 2 years to just understand what their exposure is on a debt basis to agriculture. So the last report was 2009. The next one is about to issue for the 2011 year. But as you can see, in terms of the sectors themselves, a significant build-up of debt in terms of what was funded into agriculture. So for all forms of commodity class, significant upload in debt. And I think the interesting statistic is the point at the top of the page in terms of the gross value of production from agriculture. From 2007 to 9 rose 7%, yet the average value of debt increased by 27% for on-farm. Prior to that, 2005 to 7, gross value of production actually fell, and yet money was invested into agriculture. So the whole liquidity of the market was driven by sort of other than necessarily commercial economics in terms of return. When I came into the business, just wanted a bit of a forward indicator. There's no real forward indicators in terms of the market in agriculture as far as where supply-demand pressures sit. So I just did an internal assessment, and this is actually March last year, this data, and really just asked our research guys to say, I'd like to get a bit of an idea what the future demand or the future supply is sitting on the market today relative to demand. So the green bar charts there represent the demand, so what has sold for the last 5 years, broken down into 6 monthly. So the first chart here is grazing above 5,000 hectares in Queensland. The trend line is actually the average price per hectare value in terms of the range. And so you can see where the trend peaked in 2008 and then effectively continued to fall off as the demand came forward, or didn't come forward. The grain, a similar outlook, had to go down to 1,000 hectares to get enough statistical evidence. A lot more cyclical in terms of the average price per hectare paid, but in terms of the volume of transactions, a significant trend downwards still in terms of physically just activity in the market. And ultimately the summary of that assessment suggested to me at that point in time, and again I'll just preface this was March last year, there was 40 months worth of supply of grain properties on the market and some 26 months worth of supply of grazing property. So a huge supply-demand imbalance, which was obviously translating to the effective downward price pressure in terms of values. What led to that situation was a readjustment of the liquidity parameters in the market itself. So changes in terms of attitude, in terms of bank funding, changes of attitude in terms of the ability to access capital. So the general impact of that global financial change, which really agriculture was the last of the asset classes to see the impact. It's a slow-moving cycle, as most people will know, so it's the last to probably benefit on the way up and it's the last to see the impact really on the way down, as opposed to what's that more quick adjustment on the residential and the commercial property sectors. In terms of the broad, again, ranges in terms of values and where they've moved across in Queensland, again, just an example, the northern zone just generally ticked up across the board, and whilst the line is a fairly flat line, the percentage variance there from 05 to 09 is quite significant. And then again, the central Queensland and the southern Queensland markets, so they all move different and independent relative to the major commodity drivers within each of those cycles. The impact of mining and gas, obviously there's been a few pictures, and I've got the same sort of photo in another format in a moment. But effectively in Queensland, the last 12 months, roughly 40 sales in the mining and gas sector, direct to taking agricultural assets out of play, ranging from a couple of hundred hectares through to Moray Downs, which is 126,000 hectares. Now, the premiums on average, the gas generally range between sort of 10 and 25%, because there's no compulsory acquisition rights in terms of the gas. It's just a compensation effect in the main. Whereas the mining, 15 to 40% sort of the average premium. The Mining Act in Queensland prescribes a minimum of 10% premium above the agricultural value as a starting point. And if you look at sort of analyse that sale for Moray Downs, and look, I've just sort of represented it's probably got an agricultural value in today's market somewhere between 60 to 75 million. Sold a sale price at 110, it's a premium of about 46% on the market. Now ultimately that property, there's roughly 5,000 hectares of that which will be in essence the block development, so the mine site and associated infrastructure, and then the balance of the property will be in essence leased back to the landholder in the short term. The reality is agriculture can't compete with that sort of cash in terms of, and good luck to the vendors, everyone makes their own decision. But there's another asset potentially changing class of use to a higher and better use. Around Australia, as we've seen some of the photos, that's just a very simple sort of snapshot across the country nationally where some activity is very hard to read, I appreciate. So I'll blow it up a little bit further. The Bowen Basin in Queensland, again, just an example of just some of the impact from the mining and principally mining in this case, that corridor of that coal belt all the way down through to central Queensland. And I think that the mining and gas side in isolation, the reality is it's created another market. It's its own market in place. Agriculture can't compete with the values going into that sector. It certainly has created, in essence, a two-tier market, and the reality is when we look at the assessment of an agricultural asset underlying commodity use, you've really got to strip out the mining and gas interests and say, well, they're not relevant to the assessment of this asset class. But in their own right, they have created a two-tier market. They've enabled some buyers to cash up and move down the road and then repurchase again. But it still hasn't translated into a broad trend of rising values. The trends are still, slightly on the negative side. The drivers of market value, and again, sort of break this down across, it's relatively straightforward, but you've got your lifestyle drivers around your peri-urban areas, and the factors that lead into that are really just the general economic conditions, job security, and people's weekly take-home pay. So fundamentally not relevant to the underlying commodity class itself. You move out into your family-owned sort of operations, largely facilitated through debt-driven. Some have good scale, some not so good scale. And the reality is that they are impacted by the underlying commodity value and return on the enterprise. And then your corporate and institutional end of the market, which is probably more equity driven as opposed to debt. And ultimately the focus for that market is about getting scale and the economies of the scale that can flow through so that they can actually reap the commodity return as one part, and then the underlying land value, which over a long-term trend they're looking to capture. Talk about potentially a new entry into the market towards the end as well. So sort of breaking down those ranges and what it does to values broadly, and there's just an example of 3 of the states and picking sort of the size of the property. So in New South Wales, 250 to 500 hectares. So the smaller blocks closer into that area of general economic, metropolitan and regional. And then as you move out on scale, you see the significant fall off in the actual value, because the reality is that value is relative or translating back to the underlying economic return and productivity of that property. And that will always fundamentally drive the bulk of the value market in agriculture in Australia. Just another interesting trend, and more so in the southern states, in southern New South Wales and Victoria, that we've sort of noted is that this graph here, the pink line represents the value of water licences, and it's back to beginning of this year. And the blue line is the actual land value. And whilst the aquifers are full, the river systems are full, allocations and all that are 100% allocation type thing, the value of water has actually come down, which you'd expect. But what's interesting, we've seen that there's been an uptick in some of the value of the land component, so that in total, the land and water is still the same price as what it was 2 years ago. It's just the variables. Because again, the decision to invest by the people into that sector is saying, what can I deliver from a total return on this for this agricultural investment, whether it's an intensive horticultural asset or whatever it might be. So just sort of somewhat interesting, it's the fundamentals probably in the agricultural sector are, and I think as a result of some of the financing requirements of the banks today compared to certainly the previous 10, 15 years, where interest only was great, no one had to really consider about principal reduction. So therefore your business could be not necessarily a sustainable business because it was almost artificial to a point. Well, now the requirement is you've got to be able to show how you can amortise this debt position. And so, economics is driving. You'll never get, I don't believe, a real return on equity type model where you could use from a valuation format for agriculture, unlike your commercial market and that side of it. I think some would like to try. The other thing that is impacting potentially in terms of the rural space today is the level of legislation at the environmental level. And so this is non-voluntary conservation. This is conservation as a result of legislation where the mining, gas or whatever, and someone mentioned linear infrastructure before. So where there's an impact, the requirements of most of those projects today, and indeed the upgrade of the Act in March last year at the EPBC level, has captured now all of those previous developments which were previously exempt. So rail, road, power, water, as well as your broader mining development, or it could be a house subdivision development down the road. The reality is you've got federal legislations and you've got your state-based legislations as well. And as you can see, there's a fair few state-based, and potentially some of the local councils and those represented here and around Australia, they're also looking at their own biodiversity policies and what policies they will look to put into place. Hopefully it will replicate or be similar so that we're not having a triplicate layer of cost and management. But the impact here is potentially twofold, and the major impact today is that now a lot of these projects are being captured. So the solution for a lot of these guys is to say, well, we've got the mine site over here, we've bought that, and we'll actually just go down the road and buy another block of dirt, and that becomes the offset for the vegetation impact. So potentially we're taking two assets out of production, or we're changing the use of those assets. And I'm not so sure that government policy is really wanting to achieve that outcome. But I'd suggest that, you know, we've almost got a triangular, the developer at one end, agriculture and conservation, and in their own rights the policies make sense, but you put them together and they're almost competing against each other. And so this is going to cause, I think, some issues potentially for agriculture in Australia, because nobody wants to see, a feral infested, weed infested block next door to them if they're running a viable working farming operation. And I don't believe that's where the proponents, the mining companies or gas or whatever, want to go either. I don't think they want to be the owners of these assets. But it's almost the point of least resistance is go and buy something, because we don't need to deal with anybody else today. I have the view, and in terms of the offset business, there is an awful lot of demand out there in terms of projects, which you've seen on the board, those pictures, you know, nationally, state-based, etc. And the available supply options for these issues are becoming more and more limited. And so there's going to be a real precipice come down, and somehow we've got to find some solutions that can potentially work for the environment, for agriculture, and be funded potentially by the mining operations in part. Can they all coexist? I think that's probably the question for much of this forum, Mike, and ultimately there's been some benefits for some of these integrated projects where, you know, clean, recyclable, reused water coming out of a CSG program has developed a prickle farm into a viable agricultural property with, you know, water assets, and the productive use has changed significantly. So there are those win-win type benefits around there. Whether that's going to be consistent going forward or not, you know, that's not my issue to address. I think the last area, in terms of another market play that is starting to evolve, is potentially the look at agriculture as basically just a base store of wealth again. So going back almost to, you know, what it used to be a couple of hundred years ago. There are more people from the investment fields looking at it as an asset class outside of the traditional asset classes for investment. It has a long-term history of roughly holding its value, and whilst it has its cycles, as every class does, I think there is a lot more speculation about what might hit the ground in terms of just basically wealth protection from institutional foreign investment monies, etc. At sort of that, you know, that pension fund, super fund type level, through to that large private family office type operation. So the emergence of that could provide another source of liquidity to the market. How they run it, how they manage it, and all of those other issues, you know, other people will address those sort of things. But you know, today as it sits, if I go back just to the very first slide, the reality is, you know, the sector itself, and in terms of the trends, you know, the trends are still not necessarily going up at this point. Have we seen the floor yet? I'm not so sure. I might let my industry colleague answer that question in a moment. But ladies and gentlemen, thank you very much.